In 2021, the International Monetary Fund distributed $650 billion in emergency reserves to its member states. Africa received $34 billion. Europe received $170 billion. Both figures came from the same formula, applied by the same institution in the same week. That gap is not the subject of this video. It is the starting point, because the reason that gap exists and the reason it matters runs deeper than any single allocation decision. It goes back to how the global financial system was built, who built it, and what it was built to do. This is a deep dive into the geopolitical history of African economics, specifically into the structural machinery that means a central bank in Nairobi or Lusaka, no matter how well it is run, cannot respond to a financial crisis the way a central bank in Washington or Frankfurt can, and why that asymmetry was not an accident.
What the standard framework claims. In March 2022, the United States Federal Reserve began the most aggressive interest rate hiking cycle in 40 years. Between March 2022 and July 2023, the Federal Open Market Committee raised its benchmark rate 11 times, 525 basis points in total, from near zero to a range of 5.25%. The stated purpose was to bring inflation down from a 40-year high. By 2024, it had fallen to below 3%. The tool worked. The conventional explanation for why it worked rests on three pillars. First, the Fed has institutional independence from political interference, which gives its decisions credibility in financial markets. Second, it operates with a clear mandate to control inflation and maximize employment, so markets can anticipate how it will behave. Third, it has access to the full range of monetary tools: interest rate adjustments, forward guidance, quantitative easing, and, when the system is under severe stress, emergency liquidity mechanisms that can be deployed at scale. These pillars are well documented in the academic literature. The evidence from the United States, the United Kingdom, and the European Union is genuine. The framework is not a fiction. The argument that any central bank can achieve what the Fed achieves given the right institutional design and political commitment is made in serious journals by serious economists. It shapes the conditions attached to IMF loans across Africa. It appears in the policy recommendations of the World Bank. It is, in the mainstream, the default. The problem with the default is the assumption buried inside it that every central bank operates in the same structural environment. That assumption is not supported by the data, and the gap between the assumption and the data is not a marginal one. Constraint 1. The currency of the debt. The United States government borrows in dollars, the currency it issues. When the Fed raises rates, the government pays more to borrow in the same currency it prints. This is painful. It is not existential. The economic pain stays within the system that produced it. The Central Bank of Kenya does not issue dollars. Kenya's government has borrowed in dollars through Eurobonds issued on international markets, through multilateral loans from the IMF and World Bank, through bilateral lending agreements. As of 2022, roughly 69% of Kenya's external debt stock was denominated in US dollars, according to the Central Bank of Kenya. When the dollar appreciates, as it did sharply during the Fed's 2022-23 hiking cycle, the local currency cost of that debt rises automatically, regardless of anything the central bank does. No rate decision in Nairobi changes what Kenya owes in Washington. This is what economists Barry Eichengreen and Ricardo Hausmann named the original sin of sovereign borrowing in their influential 2003 paper: the structural inability of most developing economies to borrow long-term in their own currency on international markets. The name captures the logic precisely. The vulnerability is not acquired through any single bad decision. It is inherited from the structural position that developing economies occupy in a dollar-denominated global financial system. Constraint 2. No seat at the backstop. When the global financial system comes under acute stress, the Federal Reserve functions as the dollar lender of last resort, not just for the United States, but for a significant portion of the world. The mechanism is the currency swap line. The Fed maintains permanent, unlimited swap lines with 5 central banks: the Bank of Canada, the Bank of England, the European Central Bank, the Bank of Japan, and the Swiss National Bank. These lines allow those central banks to access dollar liquidity directly from the Fed, without burning their own foreign exchange reserves, during periods of dollar shortage. During the 2020 pandemic, the Fed extended temporary swap lines to 9 additional central banks: Australia, Brazil, Denmark, South Korea, Mexico, New Zealand, Sweden, and Singapore, all of which had also accessed the facility during the 2008 financial crisis. The Central Bank of Kenya does not have a swap line. The Bank of Zambia does not. The Central Bank of Nigeria does not. No African central bank has ever been included in the Fed's swap line network, temporary or permanent. When global dollar liquidity tightens, the 14 counterpart central banks can draw on essentially unlimited dollar support. African central banks absorb the shock from their own reserves. Those reserves are finite. The backstop that the richest economies take for granted does not extend to the continent. Constraint 3. The capital flight transmission. When the Fed raises interest rates, capital flows toward dollar assets, U.S. Treasuries, U.S. corporate bonds, U.S. equity markets. That capital comes from somewhere. A portion of it comes from emerging market and frontier market assets. Investors who held Kenyan government bonds or Nigerian equities sell those positions and move the proceeds into higher-yielding, lower-risk dollar instruments. The result is a double pressure on African central banks. The exchange rate weakens as capital leaves the country, which raises the local currency cost of dollar-denominated debt, the original sin problem, activated again. And to slow the capital outflow, the central bank must raise its own rates further, even as higher rates slow domestic growth, raise borrowing costs for local businesses, and increase the government's domestic debt service burden simultaneously. The Fed's tightening cycle does not stay in the United States. It is transmitted, structurally, into economies that had no vote in the decision and no access to the tools that would allow them to absorb it. Consider what this looked like in practice. When the Fed raised rates by 525 basis points between March 2022 and July 2023, the Central Bank of Kenya raised its own benchmark rate by 600 basis points across the same period, from 7% in May 2022 to 13% by February 2024, a larger proportional tightening than the Fed itself, deployed to fight the very currency and debt pressures that the Fed cycle had amplified. The Kenyan shilling depreciated by 9% against the dollar in 2022, then by a further 26.8% in 2023, a cumulative loss of roughly 36% of its value across the hiking cycle. Kenya's external debt, 69% of which was in dollars, became correspondingly more expensive to service in shilling terms, not because Kenya had borrowed more, but because a committee in Washington had voted to raise a rate. What the 1997 crisis proved. The 3 constraints described here are not unknown. After the 1997 Asian financial crisis, which began with a speculative attack on the Thai baht and spread within months to Indonesia, Malaysia, and South Korea through exactly this mechanism, the affected countries drew a structural lesson: accumulate reserves, reduce dollar-denominated external debt, build domestic bond markets deep enough that the government can borrow in its own currency. South Korea did this. Thailand did this. Over the following decade, both countries significantly reduced their vulnerability to the capital flight transmission. Economists within the IMF and the World Bank point to this trajectory as evidence that the structural constraints on African central banks are not permanent. Reserve accumulation is achievable through sustained current account management. Domestic bond markets can be deepened through regulatory reform. The original sin, some argue, has already been partially lifted for certain middle-income economies. The argument has merit, and it deserves to be stated clearly. The structural position of most sub-Saharan African economies is not fixed by nature. It is a product of history, policy choices, and institutional capacity, all of which can, in principle, change. The problem is the ratio of speeds. Kenya's foreign exchange reserves in early 2022, approximately $8 billion, represented years of careful accumulation. Across the Fed's hiking cycle, the shilling lost more than a third of its value. The real cost of dollar debt rose sharply, and reserves fell to $6.7 billion by December 2023, slipping below the statutory requirement of 4 months of import cover. The accumulation is slow. The transmission of a Fed hiking cycle is fast. The structural gap closes, if it closes, over decades. The next Fed hiking cycle could arrive within years.
Zambia and Nigeria, 2 case studies in structural limits. In November 2020, Zambia became the first sub-Saharan African sovereign to default since Mozambique in 2016, after missing a $42.5 million bond coupon payment. The debt-to-GNI ratio that had stood at 24.9% in 2013 had risen to 168% by 2020. The Bank of Zambia, across this entire period, operated a formal inflation-targeting framework. It published monetary policy statements on schedule. It raised and lowered its policy rate in response to domestic economic conditions. By every technical measure of central bank governance, the institution was functioning. The debt crisis happened regardless, because the Bank of Zambia's monetary policy tools could not address a structural external debt burden denominated in a currency it did not issue. Nigeria's experience illustrates the swap line constraint directly. In 2020, as the Fed extended dollar liquidity to 14 counterpart central banks, Nigeria's foreign exchange reserves fell from approximately $38 billion to around $35 billion within months, even after a $3.4 billion IMF rapid financing instrument loan provided partial relief. The Central Bank of Nigeria spent significant reserves defending the naira against the capital outflow triggered by the pandemic shock. It received no emergency dollar swap line from any bilateral arrangement. It drew down its own finite reserves. The naira was devalued. It has been devalued multiple times since. The Central Bank of Nigeria did not fail to act. It acted within the structural ceiling that the architecture of the global financial system imposed on it. Why the standard framework persists anyway? The data is available to anyone with access to the IMF's World Economic Outlook, the World Bank's International Debt Statistics, or the Federal Reserve's own swap line documentation. None of it is disputed. The question is why the policy prescription, build independent central banks, adopt inflation targeting, maintain fiscal discipline, continues to be applied as if the structural constraints described here did not exist. Part of the answer is institutional. The concept of original sin was named and rigorously documented by Eichengreen and Hausman in 2003. It has not been absent from the academic literature since. But the economists who write IMF Article 4 reports, who staff World Bank country programs, who sit on the policy boards that set the conditions attached to African sovereign loans, most of them were trained in the G10 central banking tradition, in institutions where monetary sovereignty is taken as given. The structural constraints of developing economy central banking appear in the literature. They do not appear in the default policy advice. The political dimension is less subtle. Structural adjustment conditions are easier to design, implement, and evaluate when the structural environment is treated as uniform. A framework that acknowledges that the same policy produces fundamentally different outcomes depending on whether a country issues the reserve currency or holds it creates complications for the institutions that deploy that framework. The simpler model is more convenient, even when the more complex one is more accurate. There is also a visibility problem. The Federal Reserve does not need to hold reserves in a foreign currency. The European Central Bank does not worry about swap line access. The structural constraints that determine the ceiling of what African central banks can achieve are not visible from the centers of the system, in the same way that the effects of altitude are not visible to someone who has never left sea level. The policy is designed at sea level. The consequences land on the mountain. Between March 2022 and July 2023, the Federal Open Market Committee made 11 rate decisions. Each was accompanied by a press conference, a published statement of economic projections, and extensive global financial coverage. The committee has 12 voting members, all based in Washington. All 12 are making decisions about the dollar. The dollar is the denomination of approximately 47% of all global cross-border loans and 48% of global trade invoicing, according to BIS data. It accounts for roughly 59% of all official global foreign exchange reserves, per IMF COEFR data as of 2025. It is held as the primary reserve currency by central banks in Nairobi, Lagos, Lusaka, Accra, and Dakar. When the FOMC votes, it sets the price of money for the entire dollar system, including the parts of that system that have no representative at the table, no access to the backstop, and no structural tool that insulates them from the transmission. The framework of central bank independence was designed to solve a domestic problem, insulating monetary policy from short-term political interference within a single sovereign state.
It was not designed to address what happens when the sovereign state that issues the reserve currency raises its rates, and the countries that hold that currency as their only store of external value absorb the consequences of a decision they had no part in making. That asymmetry is not a policy failure, it is a design feature. The system was built in 1944 in Bretton Woods, New Hampshire, by 44 delegations, almost none of which represented the countries that now hold the majority of the world's dollar-denominated debt. It was designed for the world as it existed then. The world has changed. The architecture has not. If this channel's work is useful to you, if the history that shapes today's financial decisions is something you want to understand in depth, subscribe. Each video builds on the last. The next one takes this architecture apart at a different seam. The question the data raises is not whether African central banks are technically capable. The evidence on that is not in dispute. The question is whether a framework built for monetary sovereignty can be applied, with any meaningful expectation of the same results, to economies that hold debt in a currency they do not print, depend on reserves they cannot replenish at will, and absorb the consequences of a rate decision made by a committee they cannot influence. The framework is not wrong. The assumption that it applies everywhere is.